In this video, we will see why your stocks stay flat and what you can do about it. If you had bought specific stocks and they are not going up the way you want, watch this video. You will have actionable tips that you can use today to only pick companies, stocks that go up over time. In case this is your first video watching this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. So for the moment, I pick stocks that go up most of the time. And let me get straight to the point. I have a couple of bullet points for you, so we can start with the first one. You buy on stories, not numbers. There is no margin of safety. Yeah, what we preach on this YouTube channel is to invest rationally, fundamental investing, no trading, no emotion-based investing. Investing with your emotions and with stories will not work that much in the long term. And I mean, if you want the small story, I have spent some time in the investment fund industry and I was pitched many investments, like a lot of startups, a lot of stocks, and the stories are always great. The stories are amazing. This will be the next Amazon. This will be the next vehicle company. Hydrogen cars. Wonderful theme, wonderful investment. That's a green world for everybody. Right, the stories always look appealing. And if you go deep into the numbers, the stories are way different. The numbers are way different than the stories, because most of the time companies with great stories don't have great numbers. This is a nascent industry, a newborn industry with no clear fundamentals, with no clear profitability. So the first thing you can do, if you are seduced by an interesting story, by a sexy story, please check the numbers and check the track record of the company. In other words, is the company profitable, and has it always been the case, or is it just recent? For example, I mean, you have plenty of companies that have never turned a profit, and then for 1 year they become profitable. So there is a sexy story about the business. They say, oh yeah, it's amazing, it's the new Apple, it will be profitable forever. Just out of 1 year of profitability. Most of the time it comes back to being unprofitable. So don't be seduced by stories. This is a great reason why your stocks are going down. You are even flat or going down, or you lose everything, because you are seduced by 1 year of profitability, great stories, and after this, boom, everything crashes. There is no margin of safety. The way we use the margin of safety is you don't want to pay up for companies. You don't want to pay an expensive price. You want to pay a fair price or a cheap price. The best case scenario is you want to buy a great stock when it is cheap. So you have a margin of safety. If you think a stock, a business is worth $100, you don't buy at $100. You buy at $70 or $50. You buy with a margin of safety in case you are wrong. In case there is a mistake, in case there is a recession for some reason, you are protected by your margin of safety. And not having a margin of safety for your investment checklist is a great way to underperform the market. It's a great way to have stocks that will remain flat or even go down. So yeah, numbers. Don't be seduced by stories, and use a clear margin of safety. You can put a margin of safety in your DCF, in your PE ratio. That's fine. I've made plenty of videos about it on this YouTube channel. Second point is you chase recent winners instead of buying value. Yeah, similarly to stories, people are seduced when the stock is going up, and that's always the case, right? You have great memes, great pictures on the internet. When the stock is down, nobody wants to buy it. When the stock is up and up and up and up, everybody rushes to buy in. Even big funds are rushing to buy in. So retail investors are coming to buy the stock that is winning and winning and winning. And also institutional funds are pumping the stock. And at the end of the day, the retail investor is always the loser. They give him the hot potato at the end of the day, and retail investors are always the one who lose the most in these situations. So be careful if you want to invest in a company where the stock is going up and up and up, and you have some inertia, you have some hype around the stock. This is a great way to be left holding the bag at the end of some months, because I mean, I've seen this many times. When you are tempted to buy a stock, you have FOMO, you buy in, and 2 months after this, it goes down. You bought at the bubble, you bought at the peak of euphoria. That is a great way to lose money in the stock market. So another tip for you is, instead of buying when stocks are going up and up and up, you can buy things that are fairly stable, or going up nicely but not too much, or even going down and down and down. When stocks are hated, when they are in value territory, you buy good value at a cheap price with a margin of safety. If you do this, you increase your chance of picking stocks that go up over time. Okay, next point. A great way to not make money in the stock market, if you want your stocks to go stable performance over time, zero returns, is to focus on what doesn't matter. If you are only focused on emotions, stories, this is a great way to lose money. What is the opposite of this? What is the best indicator of long-term performance in the future? I think that's either 1, earnings per share, EPS growth, or 2, free cash flow per share. Maybe to some extent, free cash flow per share growth is the best indicator of long-term profitability. So if you analyze free cash flow per share growth, meaning what's the growth rate of your free cash flow divided by the numbers of shares, if you focus on this metric and only this metric, you increase massively your chance of picking great stocks that go up over time. That's the real long-term driver of an investment. For the kind of investing you do, like picking great quality companies with a great CEO, great management team, you believe in the business model, you believe they have a moat, a competitive advantage, free cash flow per share growth is your indicator. Don't spend too much time thinking about the rest, about asset turnover, inventory, different margins, competitors that are coming to eat some part of the lunch. The most important metric, and what you should focus all your energy on, is the free cash flow per share growth and what can impact this free cash flow per share growth. So it can be competition, or it can be the business model that is changing, or it can be pricing power, more revenue. This is what matters. And if you are focusing on things that have no importance for the free cash flow per share growth, you are literally wasting your time. So this is really, really, really important. And I see plenty of people not looking at the free cash flow per share growth. Most of the time, companies that have generated good growth in free cash flow per share continue to generate good growth in free cash flow per share. I have in my portfolio AutoZone, right? You can check on the internet the free cash flow per share growth of AutoZone. It's been going up around 20% per year for 20 years. And you know what? They can continue. Maybe not 20%, but 15% is fine. Maybe they can play around with some numbers, short-term, long-term, but at the end of the day, they will be fine. You have 2 ways of increasing your free cash flow per share. 1, you increase your free cash flow, so you generate more cash flow, you become more efficient, you generate more revenue, more earnings, etc. Or 2, you play around with the numbers of shares, because you divide it by the numbers of shares. How can you play around with the numbers of shares? At the end of the day, at the end of the year, a company has generated some cash. What do you do with the cash? You do a big buyback program. You reduce the number of your shares. You repurchase your own shares. And AutoZone, the stock I have in my portfolio, is doing exactly this. For the past 20 years, they have bought back on average, 6 or 7% of their shares every year for 20 years. That means that for the past 20 years, they have reduced their number of shares by more than 80%. So this is just here you reduce the denominator, you reduce the number of shares, and at the same time you become more efficient. You have 2 clear engines that will propel your free cash flow per share growth. And if you only concentrate on these 2 criteria, on this only metric here, you increase your likelihood, you increase your chances of outperforming. So I mean, if you want your stocks to stay flat, don't focus on free cash flow per share growth. And if you want to pick great stocks, focus on this one. Okay, next point. You skip management analysis, but the CEO drives your returns. Yes, once you have analyzed the business model of a company, the industry of a company, the whole industry, competitive landscape, the numbers, the profitability, you have to check the CEO. You have to check the management team. Because at the end of the day, the CEO will take all the decisions. The CEO will have a huge importance when it comes to business models. If you look at the best companies in the world, every time the CEO led with vision, with culture, and in the very long term, this is really important. In the short term, anything can happen, right? You can have euphoria, emotion, market corrections, the stock can go down for some reason. But in the very long term, what drives the return is the free cash flow per share growth. And how do you drive the free cash flow per share growth? Great culture, great vision. You make investment today for the very long term. And if you skip this part of analyzing the CEO, the management team, the culture, the incentives, you increase your chance of losing money. And I suppose you watching this video, your stocks are staying flat, maybe because you don't do enough research on the management. You can check several things when you analyze the management. You can check who is the management, how long have they been with the company. You can check the incentives of the management. How is management compensated? What is the bonus structure of the company? 3, how is the stock option, SBC, stock-based compensation for the company? How is the SBC? Is it large, low? Did they play around with the SBC over time? If the company is in a worse shape, for example, numbers are going down, do you have a great bonus during this year? For example, imagine you have a year, like 2022 for example, and in 2022 revenue went down, earnings went down, margins went down. Look at the bonus. Was it down in 2022? For some companies, when they say, oh, we had a bad year in 2022, let us reduce the bonus. So we reduce our salary because we've done a bad work for 2022. That's great. And for some other companies, they don't care. They take their bonus every year. They increase their dividends for themselves, the bonus, the salaries every year, regardless of the performance of the company overall. So you want the incentives to be aligned, right? Another way to have a clear view of the incentives is to check the insider ownership of the management team. How many shares does the management team own? For example, you have Mark Zuckerberg from Meta Platforms. He owns roughly 10-15% of the shares of his company. You have Jeff Bezos owning a big chunk of Amazon. You have Elon Musk owning a lot of shares. So if the stock price drops by 80%, their fortune is tied to the stock. So their fortune will be decreasing by 80%. And they don't want to do it. So another way to do a management analysis is to only invest in companies with high insider ownership. You increase the chance of making money in the stock market if the interests are aligned, right? Okay, and by the way, another tip for you, actionable tip. If you want to check the management team, you can check the track record of capital allocation. Let me explain. You can check what the management has done in 2008 when everybody was losing their mind. What did the management do? Huge acquisition with debt? Or did they take advantage of the volatility to make a huge buyback program? Or huge merger? Or some divestitures? Did they panic? What did they say publicly? Same thing in 2020. Pandemic, big shock to the world. What did the management do? Stupid decisions? Did they panic? Were they rational? What is great in this era of information is you have all this data completely for free. You have free websites that can give you plenty of information. You have interviews on YouTube about the CEO talking about their strategy in 2020. If you are a serious investor, you can do the work and find all this golden information. So capital allocation is very, very important for the performance of your stock. and you hold average businesses instead of the top 1%. Yep, if you invest in bad companies, mediocre companies, you will have bad stocks, mediocre stocks, and you have found the reason why your stocks stay flat. And the opposite way of looking at this is if you only invest in the best companies, in the best management teams, in the best business models, in the top 1% of the businesses, most of the time it will be the top 1% of the stocks. So check your portfolio right now. If you're watching this video, check your portfolio. Is this something that is really in the top 1% of businesses out there? Is this really the top of the top I can find? Or is this an average business model that I'm not sure of? I don't know if they will be here in 5 years, 10 years. If you fill your portfolio with companies that are great, your stocks will not be flat. your stocks will not be flat. I've been investing for almost a decade, and this has always been my philosophy of not really touching bad businesses that I really didn't believe in. The most money I've made was through great companies and especially great management teams, because they are flexible, they are efficient, they are rational, and they know exactly what they are doing. These are not tourists. They've been with the business for more than 20 years. They know exactly how it's done. This is maybe founder-led. So this is, you have great incentives. Now, another bullet point for you is your portfolio has no clear process. We talked about many metrics in this video, right? You have the free cash flow per share growth, incentives, margins, etc. And if you don't have a clear framework, a clear process, you're just wasting your time, and this is the reason why your stocks are flat. It's just a mix of random names. If you fill your portfolio with companies that have no clear structure, you don't have a clear process, a clear method, you're wasting your time, because you're wasting your valuable time, because you could use your time of analyzing great businesses to build up a winning portfolio. So if your stocks are flat, maybe the reason is you don't have a clear process that you can use as an evergreen. You use it again and again and again, clear checklist again and again and again, that will filter out bad stocks for you. This is great. These can be implemented really fast, actually. Building a clear framework, a clear checklist, a clear process to only keep the best, the top 1%, and filter out other investments. Now, if you're tired of holding stocks that go nowhere, if your stocks are flat and you want a real method, a real framework to build a strong portfolio, I have helped over 200 people do the same. So we can talk. You have a link in the description below to book a free call with me. We can chat and discuss your investment goals, your objectives, so that I can help you achieve your goals, to find great stocks and build a winning portfolio. So if you want some help, do that. It doesn't hurt to just have a chat and see if we can work together and if I can help you. And if I can help you, I will gladly help you to find great winning stocks that will not be flat over time. The goal is to find winning stocks that will outperform over time. So if this is you and you want some help, click the link in the description below and let's have a chat.